Good morning. As we look at the board before the opening bell, the U.S. markets are currently closed. Navitas Semiconductor, ticker NVTS, finished yesterday's session, November 6th, 2025, in what can only be described as a brutal day of trading. The stock closed at $8.83 per share, a catastrophic drop of 10.40% in a single session. Now, the immediate expectation for anyone who has been tracking this name, especially over the last month, is one of total confusion. This stock was on an absolute tear, up over 80% in the preceding month, fueled by an exciting narrative about a strategic collaboration with Nvidia for next-generation AI data centers. The expectation was that Navitas was solidifying its place as the key picks and shovels play for the AI and EV sectors. But the reality, the reason for this 10.4% collapse is that the company just reported its third quarter earnings, and the numbers are, to put it mildly, disastrous. The AI-fueled narrative just slammed headfirst into a brick wall of financial reality. The company isn't just slowing down, its current revenue stream is evaporating, and the market is in a state of shock. Let's establish the common ground, because the story was, until this week, incredibly compelling. When you logged into your Robinhood app or SoFi Invest platform, NVTS looked like a high-growth rocket. The common belief was that Navitas, with its GaN-fast gallium nitride and silicon carbide technology, was the undisputed future of power electronics. We're talking about chips that are smaller, faster, and far more efficient than old-world silicon. The company had a huge win with a partnership announced in October with Nvidia stock, positioning Navitas as a key partner for their 800-volt AI factory computing architecture. This is the big leagues. Investors were dreaming of Navitas chips sitting right alongside Nvidia GPUs in every future data center, not to mention their growing pipeline in the electric vehicle market, aiming for cars just like those from Tesla stock. The expectation was that this company was successfully transitioning from its origin in consumer fast chargers, think chargers for products from companies like Apple, into these massive, high-margin industrial markets. But here is the reality check, and it's a cold one. The earnings report on November 3rd didn't just miss expectations, it called the entire near-term viability of the company into question. Navitas reported Q3 revenue of $10.11 million. The street was expecting closer to $10.8 million. That's a miss, but the terrifying part is that this represents a 53.4% decline in revenue compared to the same quarter last year. A 50% plus collapse in year-over-year revenue is not a slowdown, it's a free fall. And then, the company gave its guidance for the fourth quarter. Management is guiding for Q4 revenues of just $7.0 million. This is so far below any analyst estimate that it triggered an immediate wave of panic selling. This explains the 10.4% drop to $8.83. It wasn't a dip, it was a repricing. So what on earth is happening? Management is framing this as a strategic pivot, something they are calling Navitas 2.0. The reality is they are explicitly deprioritizing their business in the China mobile and consumer market. They are in effect walking away from their original and largest source of revenue because it's low profit and highly competitive. They are betting their farm, all their resources on the high-power, high-margin future of AI data centers and electric vehicles. The problem, as the Q4 guidance reveals, is that this AI and EV revenue is not here yet. The company has jumped from its old revenue boat, which was sinking, but the new boat is still miles away. This creates a terrifying gap in revenue that the market is now forced to price in. We're looking at a company that is now trading at an astronomical price-to-sales multiple on forward revenues that are collapsing. This is the definition of a high-wire act with no safety net. Let's look at the institutional and analyst reaction because it's telling. This isn't just retail traders on Robinhood hitting the sell button. The professionals are running for the exits. Craig Hollum, CJS Securities, and Rosenblatt all downgraded the stock from buy to hold or market perform. The consensus rating for the stock has effectively shifted to hold. These analysts who were bullish on the Nvidia story just saw the numbers and realized the timeline is far longer and the risk far greater than anyone believed. Adding fuel to the fire, we saw reports just yesterday of significant insider selling, with the company's CFO having sold off a meaningful 9.75% of his position. That kind of move, followed by this catastrophic earnings report, is a massive red flag. You can be sure that professional traders on Interactive Brokers and Fidelity's active trader platforms saw this and acted immediately. This isn't a stock for a passive Schwab Intelligent Portfolios account. This is a highly volatile, speculative instrument. The stock's beta is 3, meaning it's 3 times more volatile than the market. Yesterday's 10% drop is a perfect example of that. For those less familiar with the company, Navitas is a fabless semiconductor company. Like Apple or Nvidia, they design the chips, but don't manufacture them. Their specialty is these wideband gap materials, GaN and CIC, which are said to replace silicon in almost every application that involves converting and managing electricity. The bull case has always been that this technology is superior. It allows for an EV to charge faster, a data center to waste less power as heat, and a solar inverter to be more efficient. The acquisition of GeneSiC gave them a strong foothold in the high-power silicon carbide market, crucial for the Tesla EV ecosystem. The company's technology is not the part that's in question. What's in question is whether Navitas, as a business, can survive the transition from a low-margin consumer supplier to a high-margin industrial partner before it runs out of cash. They ended the quarter with about $150 million in cash. With revenue this low and ongoing R&D expenses, that cash burn is now the single most important metric to watch. This brings us to the future outlook, which is now a perfectly split binary outcome investment. This is a stock for which you need a strong stomach and a clear thesis, whether you're doing self-investing on the SoFi investing platform or managing a more complex individual brokerage account. The bull case, the expectation, is that management just did the bravest, smartest thing possible. They are performing painful surgery, cutting off the diseased, low-profit consumer business to focus 100% on the Nvidia-fueled AI boom and the EV market. Bulls will argue that this $7.0 million Q4 revenue is the bottom, the trough. From here, every dollar of revenue will be high quality, high margin, and locked in with major partners. They will point to the Nvidia partnership as proof that the technology is validated by the best in the world. They will say that analysts projecting product launches from this deal in 2027 are being conservative, and that buying this panic-driven dip to 8.835 is the opportunity of a lifetime. They will argue that this is not a stock to be held in broad Fidelity ETFs or Fidelity mutual funds, but a high-conviction position in a Fidelity IRA account for long-term growth. The bear case, the reality check, is that this is a company in complete free fall. The strategic pivot is just a fancy term for our main business has collapsed. The bears will say that the Nvidia partnership is real, but meaningful revenue is years away, as some reports suggest. In the meantime, Navitas is a company with collapsing revenue, negative earnings, and a ticking clock on its $150 million cash pile. In this high-interest rate environment, unprofitable growth stocks are punished severely. The cost of capital is high, and Navitas will almost certainly have to raise more, likely by selling more stock and diluting current shareholders. The bears see an $18 billion market cap on a company that is guiding for $7 million in quarterly revenue and is telling you its legacy business is gone. They see a stock that could easily fall another 50% from here. This is the ultimate test of investor belief. This brings me to my question for you as you look at this situation on your Fidelity mobile app or SoFi trading platform. Comment below with pivot if you think this strategic shift to AI and EV is the right move, or panic if you think this revenue collapse is an unrecoverable red flag. To summarize, the stock is at 8.835 because the market is reacting to a terrifying bait and switch. The expectation was a high-growth AI story layered on top of a stable consumer business. The reality, delivered by the Q3 report, is that the consumer business is gone, and the AI story is the only thing left with a timeline that is far longer and more uncertain than anyone was prepared for. The gap between the long-term technological promise and the immediate, dire financial reality has opened up, and the stock has fallen right in